today's session, we will be starting off with a problem from the exam kit named Furnival. This is a problem on joint products further processing decisions. Now, the people who are setting the question paper for the ACCA exams will twist and turn the question in such a way that even though we know the basic concepts, we may still not be able to attempt the long questions. So what I want you to do is, whenever you get a problem on joint products further processing decisions, I want you to draw a diagram. This will help you to tackle the question even if it is complicated. So let's get to see how we draw this diagram. So first you write the joint cost, whatever the amount is given in the question. And then you have the split off point and say you've got three products P, Q, and R. The ratio in which the three products are produced might also be given in the question. So you can include the ratio also. Next, for each product, that is for P, Q, and R, please write number of units produced at split off point and the selling price at split off point. Next comes the further processing cost. There could be three types of further processing cost. One is the variable cost. What do you mean by variable cost? Any cost that varies with the number of units produced. Second is the specific fixed cost. Now I will give you an example of a specific fixed cost. Suppose for product P, you need a particular machine for further processing and you are taking this on rental basis. So the rent is exclusively related to product P. It is not related to product Q and product R. So such kind of fixed costs which are exclusively related to a particular product are known as the specific fixed cost. Now the third type of further processing cost is the shared fixed cost. Now there could be fixed costs which should be shared between the three products. For example, if you are going to employ a supervisor, the supervisor will supervise the further processing of all the three products, which means that the salary, which is a fixed cost, which is paid to the supervisor, has to be divided between the three products, that is P, Q, and R. Such kind of fixed cost are known as shared fixed cost. Please note that shared fixed cost is for all the products, that is P, Q, and R, and specific fixed cost are fixed cost relating to only one product. That is the only difference between the two. Finally, you have to take note of the number of units which are produced after processing, along with the selling price after further processing. So you've got two selling prices. This selling price is the selling price at split off point, and this selling price is the price that you realize after further processing. So once you compile the information from the question in this format, you will be able to complete the answer in a jiffy. So let's go to the question extracts and see how the problem has to be done. So these are the question extracts. Furnival has a distillation plant that produces three joint products, P, Q, and R, in the proportion of 10:5:5. So we will draw the diagram. So we have the joint cost line and then we have the split off point. So in the question, it is mentioned that there are three products, P, Q, and R, and the ratio in which these units are produced is 10:5:5. So we include that. Moving forward, after split off point, the products can be sold for industrial use or can be taken to the mixing plant for blending and refining, which means that we have got two options. One is we can sell it at split off point, that is sold for industrial use, or it can be taken to a mixing plant for blending and refining. So it is a mixing plant where the further processing takes place. So we will draw the arrow for the further processing. Further in the question, they have mentioned for a typical week in which all output is processed in the mixing plant, which means that they are doing further processing because mixing plant is coming here. The income statement is, so you have the sales in gallons, that is nothing but the units. Then you have the selling price. This selling price is after further processing, okay? And then we have the sales value, that is sales in units multiplied by selling price per unit, you get the sales in dollar. And further down, you have the joint process cost, and then you have the mixing plant cost. Now, the one thing that you have to note in the income statement is R is incurring a loss of $1,000. Please put that fact in your mind. So we will take one by one. So first we will include the sales part in our diagram. So as I said, this is the sales that is happening after further processing, which means that it is to come here. So as far as product P is concerned, 1,000 units at the rate of 12.5 gives an amount of 12,500. And as for Q, it is 500 gallons at the rate of 20, giving a sales value of $10,000. So we include it against Q. And finally, for R, it is 500 gallons at the rate of 10, giving an amount of $5,000. So we write that against R. So we have included the sales part also in our diagram. Moving further down the income statement, we had the joint process cost. So let's check the details. Joint process cost apportioned using output volume. Okay, so they have mentioned that the joint process cost have been divided between the products based on the output volume. And what was the output volume ratio? In the first para, they had said that the output volume ratio is 10:5:5. If you notice here, the joint process cost has exactly been divided in the ratio of 10:5:5. Simplified, it is 2:1:1. What should we take note of? We should take note of the total joint process cost in our diagram. So 5,000 plus 2,500 plus 2,500 gives an amount of $10,000. So we will include that against joint cost. So joint cost is $10,000. Now they have mentioned that the joint costs are 25% fixed and 75% variable. We have seen in the last class that for all the further processing decisions, joint process costs are completely ignored because it's a past cost. So this information, that is joint cost are 25% fixed and 75% variable, is not relevant. As it is, we are not going to consider joint cost for decision making. Moving forward, what is mentioned in the income statement is mixing plant cost. What was mixing plant? Mixing plant is the further processing that is taking place. Mixing plant comprises of the process cost, $3,000 for P, $3,000 for Q, and $3,000 for R. And you have the other separable cost as $2,000 for P, $500 for Q, and $500 for R. Now they are further saying mixing plant costs are 10% fixed and 90% variable, and all the other separable costs are variable, which means that this is completely variable. Other separable cost is a variable cost, and process cost is fixed cost 10% and variable cost 90%. Okay. Now what we will do is we will first input the variable cost in our diagram. So as far as product P is concerned, please listen very carefully. $3,000 is the process cost, out of which 90% is variable. So 3,000 into 90% should come here. What is 3,000 into 90%? It is $2,700 plus the variable cost of $2,000. So I will write that against P. So it is 2,700 plus $2,000. I will explain once again. What is the variable cost written against product P? $3,000 multiplied by 90% because only 90% is variable, plus $2,000, which is completely variable. So that is why 2,700 plus 2,000 has been indicated in our diagram. Now moving to product Q. Again, product Q, 3,000 into 90% is variable, which means that 2,700 is variable. And $500 is also completely variable because other separable costs are variable. So what is the amount that we have to write against Q? It is $2,700 plus $500. $3,000 is the process cost, out of which 90% is variable. So 3,000 into 90%, which is 2,700. And $500 is also purely variable because other separable costs are variable. So the amount to be indicated against product R as far as variable cost is concerned is 2,700 plus 500. They are telling you mixing plant costs are 10% fixed. Mixing plant cost.
mixing plant is being used for product P, Q, and R, which means that the 10% fixed cost relating to the mixing plant is a shared fixed cost. It is not specific to any particular product. So we will have to include under shared fixed cost. So mixing plant cost 10% fixed. It is 3,000 into 10% or $300 for product P. So we write $300 here. Likewise, for product Q also, it is 3,000 into 10%. So again, $300 here. And for product R also, it is 3,000 into 10%, again a $300 because it is mentioned that mixing plant costs are 10% fixed. Now, moving forward, they have mentioned in the question, if the products had been sold at the split-off point. Now we are coming to the split-off point, okay? Had been sold at the split-off point, the selling price per gallon would have been 5, 6, and 1.5. So we got the selling price at split-off point. So let me make a note of it. So we have 5 for P, 6 for Q, and 1.5 for R. Now, can you tell me what is the number of units that have been produced at split-off point? I have not included that here because the question doesn't mention the number of units that are produced at split-off. But if you notice here, they have given you a hint. What have they said? The units are being manufactured in the proportion of 10:5:5. And that is exactly the ratio in which the final goods have also come up, which means that this is the same thing that will come here because this is also in the ratio of 10:5:5. And the question is completely silent as to the number of units that is produced at split-off point. So we can very safely assume that the number of units that are produced at split-off point is also 1,000 for P, 500 for Q, and 500 for R. So since it is the same thing, I'm not writing it on the left side.
Moving forward, there are only 45 hours available per week in the mixing plant. So in the mixing plant, totally 45 hours are available, out of which 30 hours are for processing of P, Q, and R, 10 hours for each, which means that for product P, it's 10 hours, for product Q, it's 10 hours, and for product R also, it is 10 hours each. And 15 hours for other work that generates a profit of $200 per hour. So out of the 45 hours, 30 hours is used for the processing of product P, Q, and R, and the balance 15 hours is used for another work that generates a profit of $200 per hour, which means that we have an alternative use for the existing mixing plant. And please note that the other work generates a profit of $200 per hour. What they have mentioned is profit, not contribution, after charging proportionate share of the plant's cost, including fixed cost. Now, we know that for any kind of decision making, we do not need to consider the fixed cost. Why? Because whether we decide on a thing or not decide on a thing, fixed cost will remain same. That is, it is not incremental. What is profit? Profit is contribution minus fixed cost, correct? In this profit, fixed cost is not relevant because fixed cost will remain fixed, whatever decision we do. So we never take fixed cost for any kind of decision making under relevant costing. So we have to take only the contribution. If profit is equal to contribution minus fixed cost, then what is contribution? It is profit plus fixed cost, right? Now moving further, manager of the mixing plant can sell all the plant's processing time externally at this profit. So what is said? If the further processing is not done, then the plant manager could generate a profit of $200 per hour, which means that just because we are processing, we are losing out on the contribution that we would have earned from this other work. So we will calculate the lost contribution. Lost contribution is profit. You add back fixed cost. So we will first calculate the fixed cost per hour. We know that product P takes 10 hours for further processing because it is mentioned 10 hours for each product. So what is the fixed cost per hour? 10 hours, $300. So per hour, fixed cost is 300 divided by 10 or $30 per hour. So we know the profit as $200 per hour, and we have calculated the fixed cost as $30 per hour. So the loss contribution is 200 plus 30, giving an amount of 230 per hour. So if we are not further processing, we will get 230 per hour. If we are processing, then we lose that 230 per hour, lost cash inflow. Now we will see what they have asked in the first part of the question. Since R regularly makes a loss, should it be sold at split-off point? So we saw in the income statement that R was making a loss. So the question that has been asked is, should R be sold at split-off point or should R be further processed? So what did we learn in the previous class regarding further processing decisions? We have to first take the incremental revenue of processing. From that, you reduce the incremental cost. And from that, you have to reduce the lost cash inflow. The final figure that you get, if it's positive, then further process. If it's negative, you should not further process and the product should be sold at split-off point. So first we will take the incremental revenue of R. So all eyes on R only. So what is the incremental revenue that R makes when you further process? At split-off point, R selling price is 1.5. And after further processing, our selling price is $10 per unit. And how many units are manufactured? 500 units or 500 gallons. So the incremental revenue is $10 minus $1.5. That's the additional selling price that you get for 1 unit. And how many units are there in total? 500 units. So it will be 10 minus 1.5. That's the additional selling price that you get multiplied by the number of units. So it is into 500. So the incremental revenue amounts to $4,250. Now coming to the incremental cost. Now be very careful here. For incremental cost, you should take only the variable cost and the specific fixed cost into consideration. This is very important. You should never take the shared fixed cost. Why? Even if you are further processing R or you are not further processing R, you will still incur the shared fixed cost because the shared fixed cost was for all the products and not for R alone. Because what was shared fixed cost? It was the fixed cost relating to the mixing plant. Mixing plant we are using for product P and product Q also, which means that even if R is not processed further, we will still incur the shared fixed cost. It does not satisfy the basic feature of relevant costing. That is incremental in nature. So under incremental cost, include only the variable cost, that is 2,700 plus 500, giving an amount of 3,200. Since it is a cost, we are reducing. And what was the lost cash inflow? Lost cash inflow is $230 per hour. And we know from the question that each product was taking 10 hours for further processing. So for each hour, you're losing 230 per hour. So for 10 hours, what is the lost cash inflow? It's 230 multiplied by 10 or $2,300. So the net revenue that you get if you process R is 4,250 minus 3,200 minus 2,300, giving an amount of negative $1,250, which means that it is not worth to further process R. So the final decision is sell R at split-off point. Do not further process R. Moving to the second part of the question, product mix can be changed to 7:8:5 at a cost of $1 for each additional gallon of Q produced by the distillation plant. Should this be implemented? So they are asking you, if you change the product mix from 10:5:5 to 7:8:5, is it better? So when the product mix is changed, let's see the number of units of each product that will be produced. So right now we have
2000 gallons, that is the total of 1000 plus 500 plus 500, in the ratio of 10:5:5, which means that 1000 for P, 500 for Q, and 500 for R. They are telling you the new product mix is 7:8:5, which means that we have to divide 2000 gallons in the ratio of 7:8:5. So what is the total of this? The total is 20. So for P, it will be 2000 divided by 20, that's the total, multiplied by P's share of 7. So what is the quantity that you get? 700. Likewise, do for Q. So it's 800, and for R, it is 500. So what do you see? R, the quantity is anyway remaining the same. And as such, we are planning to discontinue the further processing of R. Now focus your attention only on P and Q. So if you see P, it has reduced to 700 units as per the revised mix. So there is a reduction of 300 units as far as P is concerned. And as far as Q is concerned, from 500 units, it has increased to 800 units. So there is an increase of 300 units as far as Q is concerned. Now, what will be the impact if you reduce the quantity of P by 300 units and if you increase the quantity of Q by 300 units? One thing that is mentioned in the question is $1 for each additional gallon of Q produced will be incurred. That is 300 into $1. $300 will anyway be incurred because of this change. What else will happen? Think for yourself. Instead of 1000 gallons, we are getting 700 gallons only. And instead of 500 gallons, we will get 800 gallons of Q. So definitely the sales value will undergo a change that we receive from product P and product Q. And the variable cost, since it is dependent on the number of units, that will also undergo a change as far as product P and Q is concerned. Now my question is, will joint cost change because of a change in the product mix? No, joint cost will not change because it's not mentioned in the question, which means that we do not need to consider joint cost for our decision making because it's not incremental. There's no change taking place. And what about the shared fixed cost? Shared fixed cost will also not change because shared fixed cost was a fixed cost relating to the mixing plant. So mixing plant, we are not selling or buying. So obviously, the fixed cost relating to the existing mixing plant will be the same, even if you follow the old product mix or if you follow the new product mix, which means that it is not incremental. So shared fixed cost also need not be considered for this decision. What is this decision? The decision of changing the product mix. So the only two things that you have to pick for deciding on a change in the mix is the sales value and the variable cost of the two products P and Q. So we will do the calculation. So sales value minus variable cost is the contribution. So let's see what is the present contribution. So what's the present contribution? It's 12,500 minus 4,700 as far as P is concerned, because variable cost total is 4,700. And for Q, it is $10,000 minus $3,200. So let's write that in the table. So we have 12,500 minus 4,700 for P, giving an amount of $7,800. And for Q, it is $10,000 minus 3,200, giving an amount of $6,800. So our present total contribution is 7,800 from P and 6,800 from Q, giving a total amount of 14,600. Now, if the product mix is revised, instead of 1,000 units, we get 700 units of P. And instead of 500 units, we get 800 units of Q, right? Now listen carefully. For 1,000 gallons, the contribution is $7,800. So for 700 gallons, what is the contribution? It is $7,800 divided by 1,000 gallons multiplied by 700 gallons. So that is what I have written against P. And for Q, what is the revised contribution? $6,800 is for 500 gallons. So for 800 gallons, what is the contribution? It is 6,800 divided by 500 into 800. So that's what's written here. Let's solve it to get the revised contribution as 5,460 for P and $10,880 for Q. We have an additional expense because of our revised product mix. It is $1 for each additional gallon of Q produced. So additional gallons of Q produced is 300. So the additional expense is 300 multiplied by $1 or $300. Since it is an expense, I'm going to put that in bracket for reducing. So we get the total revised contribution as $5,460 plus 10,880 minus 300, giving an amount of $16,040. So definitely it's better to revise the product mix, because under the old product mix, we were just getting $14,600. And under the revised mix, we are getting much more. That's $16,040. So what is the additional amount? Additional amount is 1,440. That is 16,040 minus 14,600. So the final decision is implement the change in the product mix, as gain is $1,440. Now let's take a quick look at the key takeaways from this question. Whenever you are given a joint product wherein the further processing decisions have to be taken, you have to draw a diagram like this. So first you have the joint cost, then you have the split off point, and then you have the further processing cost divided into three. One is the variable cost, the other one is the specific fixed cost, and the third one is the shared fixed cost. Now, the reason for drawing the diagram is very simple. Sometimes they will give that the variable cost increased by a certain percentage, or the specific fixed cost has been doubled, or the shared fixed cost is no more. So in order to get the clarity, this diagram will help a great deal. Now, for all further processing decisions, first you take the incremental revenue, then you reduce the incremental cost, and then you reduce the lost cash inflow or the opportunity cost. You get the net revenue, and if it is positive, then you will have to further process. So as a summary, we can write, joint costs are never considered for further processing decisions. Second, incremental revenue, incremental cost, and lost cash inflow are considered. That is, these three items are always considered. And among the incremental costs, this is the key thing, shared fixed cost will not be considered if the further processing decision is to be taken for one product only. What did we see in this question? In this question, we were asked whether we should further process product R only. That is, only one product's further processing decision was involved. In such kind of cases, shared fixed cost will remain as such, whatever we decide. That is the reason why we did not consider the shared fixed cost. Now let's take the case where the question asks you whether all the three joint products have to be further processed. So in such kind of situations, we have to consider the shared fixed cost. Why? Because if we are not processing all the three products, then definitely the shared fixed cost will also not be there. So always think carefully and then attempt the question. So the final point is, shared fixed cost will be considered if the further processing decision is to be taken for all the joint products. So we are finally done with the question. If you have found this video useful, do click the subscribe and the like button, and do share it with your friends whom you feel will benefit from the video. So thank you all, and meet you in the next video.